New York has an epicenter of many different other industries. We touch many, many different fields, and so we may not be the technology capital of the world, but I think we're like the industry capital of the world. Yeah, venture capital is about investing and supporting early stage entrepreneurs. And so that means you're finding companies that are hopefully diamonds in the rough. You're doing diligence. And so you're trying to figure out if that investment is a good fit for your investment profile. And then you're making the investment. You may or may not be taking a board seat, but at the end of the day, you're also finding ways to be supporting of those companies. And so what do they need to get done to make their chance of success much higher? You'll do so. That means recruiting, helping with fundraising, strategy, business development, even maybe sales. And so those components make up a lot of the different pieces of venture capital. On top of that, obviously, if you're running a fund, you have to fundraise for your fund. And that's another kind of back office type of thing that we try to focus on as well.
So you mentioned a couple of different disciplines, and I think about if I was, a person coming out of college and I wanted to do venture capital, you added other things other than just giving money to startups. And what are those other things that make a VC partner a good partner instead of just a checkbook?
Yeah, I think it's hard to add value because you never know what's happening in the day-to-day of a business or a startup, which is why you have to try your best to be as hands-on as possible and be as intimate and close to those founders as possible. And so the things that we work on is, with our portfolio company CEOs, we talk to our CEOs every 2 weeks. We've got scheduled sessions so that we can ask them, how are things going, how can be helpful? Because when you're running a company, you're too busy. You can't think of like, how can Will help me or Rich help me? You need to have scheduled time for them to ask, what are your needs right now and how can I be helpful? Sometimes that may be, I need to hire a VP of engineering. Can you help me? Sometimes that means I'm getting ready to fundraise. I need to practice. I need to get my story right. I need to figure out which investor I should be targeting. And sometimes that means, hey, we're thinking about changing our business. Like we were doing this today. We think it makes more sense to pivot in this other direction. Can we run our strategy and our vision by you to get a sense of like, is this the right path for us? And so it's a variety of things, but what we try and do is be proactive about being helpful and make those conversations happen because it's really hard to elicit how a founder can need help without asking that question in the first place.
So at what stage should a startup be talking to a VC versus like an angel or just, family and friends?
Yeah.
Talk to me about the different stages of the progression of the types of investors I should be talking to.
Sure. Angel investors and family friends are just folks that will kind of invest in a person, right? Sight unseen what your idea is. I'm a believer in Will. I want to support whatever Will's doing. And so those are hopefully the first dollars you can get. Those dollars aren't easy. As an undergrad coming out of college, I did not know folks that could give me $1 million or $500,000 to get started. So it's very hard to find family and friends. But they do exist, and I think they exist for a reason. With that said, though, it actually can be easier to access sometimes actual venture capitalists. They have websites, their profiles, they build their own personal brands. It's really hard to know who's an angel, who has capital as an individual or not. Now, the timing for targeting a venture investor versus an angel is tricky because some investors at a venture fund will invest in a company before it's even begun, before it's started, before it's incorporated, before there's a product in place. And some will want to see traction and data. And so it's important to figure out what's the right fit investor profile for you as a company. So if you're just starting out, maybe it's you and your co-founder, you probably want to focus on what is now called pre-seed funds. These are funds that will help you raise capital before you actually have built a product. The capital, whether it's $500,000, maybe less, maybe more, the sole focus of that capital is for you to get the product in market so you can get to a spot where a seed investor like myself will be more comfortable taking risk on you as a founder.
A seed investor,
correct?
Not a pre-seed. So
correct.
Okay.
There's been this new bifurcation amongst pre-seed and seed, where pre-seed is no product, let's give you capital to go build something, and seed is there may or may not be a product in place, but what we think about it is you're about 12 months away from demonstrating product market fit. Okay. And what we try and work with our founders is to figure out what is product market fit for your company and how can we help you get there beyond just the capital that we're hopefully going to provide to you.
How do VCs make money?
Yeah, so VCs make income in two ways. One, salary, and the second piece, carry. And so, just to make the math easier, let's say you have a $100 million venture fund. The GPs generally will take 20% of the carry, which is 20% of the profits. So let's say $100 million fund, we've returned $200 million of capital back to our LP, i.e. I've made $100 million of value for my investors. 80% of that money will go back to your LPs as their profit. 20% will go to the partners of the fund. So $20 million will go spread out however you guys agree to amongst your partnership. And that's kind of the profit / carry that you'll take. At the early stage, at the seed stage, it takes a while to reach that because our companies are very, very early. They may not exit for 5, 7, 10 years. And so it takes time to get to carry at the early stage. It's a much shorter time frame at the later stage. And the last piece is funds generally take 2% of those fees, of the capital, for management fee to run their business. And so $100 million fund, generally management fee is 2%. So you have $2 million in that example each year to run your business. And that $2 million goes to pay your salary, your employee's salary, rent, travel, entertainment. If you feed your team, all these things go into that budget that you have to kind of manage for that capital.
So in your opinion, what makes a good VC? What are the characteristics of somebody who could be good at this?
Yeah, I think the traits for an individual are just inherent in somebody else. It's not really about like what you studied in school. It's much more about like who you are as an individual. Are you intellectually curious? Are you do you enjoy learning about different things? And I guess lastly, do you enjoy helping others? Those are really 3 points that are inherent to anybody that could make them a successful venture capitalist. Because at the end of the day, sourcing is a big piece. So finding companies, and that means, do you get excited by finding new things? Like you can see that in any industry. You could get excited by finding the rare sneaker that you haven't seen come out yet, or that new track on Spotify you haven't heard yet. That excites people, and finding a new company excites venture capitalists. Doing diligence, so diving deep to figure out what's this company do, what space are they in, how can this company get very, very large? That's just learning. If you enjoy learning, you'll enjoy diving deep on a company, understanding how it works, or the industry that it operates in. And then lastly, when you're on a board of a company or an investor, you're trying to do everything possible to help that company. Try to give them as many unfair advantages as possible so that the founder has less on their plate and the team has less on their plate. And that's all that is really, is helping people. So if you enjoy helping people, that's a great way to kind of manifest that inherent trait of yours to do good for a company.
So let's talk about New York, and particularly doing venture capital here in New York. Finance capital of the world, some would argue, or many would argue. And what is the difference between doing venture capital here versus doing it in the Bay Area or in other smaller markets that you think?
Yeah, I think the Bay Area is the tech capital of the world, period, full stop. I don't think we can lay a claim to that. But I think New York has, you mentioned finance, New York has an epicenter of many different other industries, whether it be finance, media, advertising, lots of e-commerce. And so we touch many, many different fields. And so we may not be the technology capital of the world, but I think we're like the industry capital of the world, because there's so many industries that call New York their home and their HQ. And we think that allows us to kind of see and better understand different kinds of businesses. And so we don't have to just look at a pure software businesses. We can look at companies that maybe have a little software, but actually still have many other moving parts that aren't really software related. And because the nuances of these verticals that are based in New York, we have contacts, networks, and have a better understanding of these other verticals that maybe aren't just considered tech only.
You had done a study, I don't know if you want to call it a study, but you did some research a couple of years ago on why there is not a lot of Black people in venture capital across the country. I want to say it was 3 or 4 years ago. Now the original post went up on your website. What did you learn then, and what has not changed, or what has changed?
Sure. Yeah, I guess what I've learned is that, looking at the data, I didn't learn anything, which is that I already knew there were very few Black folk in venture capital. I could probably count on one hand when I was back in the Bay Area in 2010 when I first started. And so the data didn't surprise me. I wrote the report and the data because I wanted folks to have a voice. I wanted to kind of shine a light on the problem, because I feel like when you discuss problems without data, people are like, I don't see it. I can't really, it's not tangible to me. I can't grasp it. And so I thought if I put data around the issue, people would understand how bad it is and then think through how can we think about those changes. What I have seen positively, though, is that there's now more and more African Americans and Black folk in the kind of junior ranks of venture capital, so the associate role, the principal role, which generally is, the stepping stone to become a partner in a fund, which I think is great to kind of build that pipeline of folks. It's still not near enough to kind of replace we'll call it the old guard in venture capital, but there's more to do there. I think the other thing that I'm seeing positively is that there's more and more funds started by Black GPs. I think the problem with trying to create, or I should say correct, the lack of diversity in venture capital is that most venture funds don't hire anyone any year. Like the average venture fund hires 0 people per year. It's a small group of people, small teams, and so if you're not hiring every year, you really can't change the dynamics of your team. And so one way to actually change it is to just create newer funds. And I think as we create more funds, those funds themselves will be more diverse, and then we'll see more progress in terms of diversifying the venture capital industry.
Have you seen a lot of progress with regards to Black founders being able to raise money successfully and Black women particularly being able to raise money successfully?
There is some progress, not nearly enough though. I mean, I think the numbers are still very anemic on Black female founders that are able to raise meaningful amounts of capital. And I think it's a couple reasons why. One, the industry dynamics. When there aren't investors that look like you, they're less likely to trust you, believe in you, want to invest in you, want to support you. And that makes it challenging for anyone who's a person of color to be able to kind of raise capital in that environment. Similarly, it's hard to get in the venture industry as well as a junior member or not, because people aren't looking for that. I think the other piece too is accessibility. And so if the venture investors don't look like you, the chances that you're in their orbit or someone you know is in their orbit is very, very limiting. Now, on the positive side though, we are seeing more and more funds pop up that are focused on women, people of color, African American founders. And I think that's great. We need more and more of that. And I think as we see more of that, the legacy venture funds will realize they're missing things and spend more and more time on that dimension. And so I think the biggest challenge right now for a person of color or a woman founder is that seed stage. I think it's really hard to get that round done. Once your product's in market, you've got traction, it makes it easier for a investor who doesn't look like you to get there, because they can like put you aside and look at your numbers. Now with that said, it's hard to get to that point. And if you're boxed out from actually even having a chance of building income in the first place, it's very, very limiting pipeline. And so I think there's a lot more work to be done there. I don't have all the answers, but there needs to be more work to be done to think through that as well.
Yeah, and again, you just said I don't have all the answers, but I think about even if, with the amount of Black investors we have today, Black female investors and people like you, Black men investors, there's so many amazing companies or potentially amazing companies, and there's just not enough of those investors to go around that are, tenable to being able to write them a check. Mm-hmm. But there's also a conversation about, by any means necessary, I got to make this company happen. What do you say to those companies that are listening and watching this and who may run into you at Afrotech or may see you in the street down in here in New York? Because what happens in my experience, I see so many, and you guys become like the savior. So you're the only ones. Yeah. So everybody's got to come see Richard. Mm-hmm. And so, but you can't fund everybody, sure, and you can't listen to every pitch. And so I see you at Afrotech, and you've got a line of 100 people. Mm-hmm. 100 people are pitching you. Yeah. I may have the best idea, but I'm number 65, mm-hmm. and you're desensitized to it by that point. So what do you say to those folks who are, trying to make it happen at the seed stage, mm-hmm. and even in pre-seed stage to be able to get to you? What do you say to encourage them?
Yeah, I think you said it best, by any means necessary. And so it may be a cold email. It may be, they know Will, and they know Will knows Kerby, and so they can use Will as a conduit to get to Kerby. I think the challenge with having so few investors that are Black in the space that want to support Black founders is that the legacy venture funds assume that like Kerby has seen every deal of every Black founder. And so, this founder came to me, I got to ask Kerby, what do you think about Will? And if I'm not investing in Will's company, that's like a negative signal to them, which shouldn't be the case. as you said before, there's thousands of companies. They can't all be a good fit for what I do at Equal Ventures or what we do at Equal Ventures. And so it's finding the right fit. And I think that is a dynamic that's bad for the industry. And we need to find ways to improve that. And so I think that means having more people of color in venture. And then that helps pursue or open the doors for more founders that can say, hey, I don't have to only come to Kerby or, folks at Harlem Capital or Charles at Precursor or anyone else. It's, my options are actually limitless. And we need to get to that point to enable as many founders of color as possible to raise capital at the early stage, because at the point in time right now, like, founders aren't succeeding not because their business sucks, their idea sucks. You're not getting a chance. You're not even giving the capital to give you a shot to go kind of test out your idea. Whereas our counterparts can have nothing to show for it, raise millions of dollars and go test it out. We need to get to that level of parallelism to make the industry more equitable.
When you think about taking that $20 million and running,
Sure.
versus, when founders come to you, everybody believes they have $1 billion business, I would assume, in the macro.
Sure.
Everybody thinks everybody wants to buy their product. How do you bring founders back down to earth in some respect, but also encourage them to think bigger than they may be thinking about the opportunity for their product or service?
Yeah, so we focus on the seed stage for us at Equal Ventures. And so for us, most companies are coming to us with like an initial product in place. They haven't built out their full vision yet, but they have a larger vision for what they want to accomplish. And we call that initial product like their wedge. So what's your wedge into the market? The initial product that will get you access to your customer base of the future. And our viewpoint there is, what are you building internally in your company that will allow you to attract more data to then go after what your larger vision may be, whether it be a point solution today and a marketplace in the future, or a point solution today and building a platform for your category in the future. And our viewpoint there is, we want our founders to know what that vision is, but even if that vision ends up not becoming $1 billion business, that's still fine for us. We're a $56 million seed fund, and we don't require our founders to be able to have to build a business to be $1 billion for it to work for our model. Now, do we want that to happen? Of course. We want every company to get to that size and scale. But given that we are a smaller fund, we take high ownership and write large checks for seed rounds, that model can work just fine for us if a company sells for less. And so when we invest in the seed stage, call it 12 months later, we have a convo with our founders and say, hey, you have a point in time here where you can go the kind of supercharged route of taking more capital on and putting the goalpost for success much further down the road for you, or you could take a less capital inefficient path and say, hey, you know what, I'm going to go this other route, build a great business, but don't have to have the kind of bearings of having to build a $1 billion company for success in my mind.
When you see people who have that sort of thinking, is it something about their personality that says, I'm not trying to build Google, I just want to take my eyelash,
Sure.
my eyelash product company and do a couple $1 million a year and live a good life? Like, what is it about those founders that say, that you found that say, I understand what the market is like for this and I'm going to be realistic about it and just live a good life based on a good income? Yeah,
so I think two kind of questions there. One is like, there's certain businesses that shouldn't take venture capital. And so if your business will kind of probably cash flow nicely out of the gate and there really aren't scalable paths of building a software-enabled business, you might not need venture capital. Might be other ways of financing.
Software-enabled, can you describe that?
Yeah. So there's current workflows, let's say, across any industry that happen manually today. Like for instance, let's say benefits selection. So I'm a large company. You mentioned Google. I'm Google. I may want to work with a benefits broker to select what benefits I want for my employees. So I want dental or vision or whatever I want to offer my employees. And then that process today works with you talking to a broker talking to a carrier in a very like manual, face-to-face, email, phone call discussion. But now you think about how do you add software to that layer so that you can have a more fluid and efficient process for benefit selection, benefit discovery. And that's an example of what software enablement could look like in the benefit space, and that can apply to many other verticals, in our opinion at least. Back to your previous question around like thinking about scale and so forth. And so for that first class of companies, you may not be a good fit for venture capital at all. The way we think about founders that are looking for like these home run or a larger vision is twofold. One is founder market fit. And what we mean by that is, why are you and your team the best team to go approach this model? And we think people get it in one of two ways. Either you've spent your entire career, majority of your career in that market. So if you were in the benefit space, maybe you spent 10 years in benefits, know it inside and out, and you're the best person to go solve this. Or it could be you have a personal experience or passion for it that led you down this path to become an expert. And so one of our companies in our portfolio is a company called Jerry. They work in the senior living space. And the founder had an instance where his father had Alzheimer's. And he had to find a home to put his father in a memory care scenario so that he could be taken care of. And he was from Canada originally, and Canada has great medical benefits, and it was super easy for him to do so. Fast forward, a couple months later, his wife's parents had the same issue. They live in America, and the process was very, very different, very, very painful. And he thought, okay, I'm experiencing this personal experience, and it pains me. I want to find a way to improve on this process. And so you can have it either from your career or your personal life, that founder market fit that we look for. And then at the end of the day, it's hard for anyone to turn down a great exit opportunity. Let's say a company comes and says, hey, we want to buy your business for $100 million, and you own half the business or something like that. It's a lot of money for you. Even though you might believe that this could be $1 billion business that could make hundreds of millions of dollars, the thought process there is it might make sense to think about secondary. And so if you can give a founder some capital today, that fills them, relieves them of their stress of, paying for their home, paying for childcare, paying for school, and if you can take that stress away from them financially, they can think about, envisioning that larger vision of that company that they hope to succeed and build.